Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Sounds good to me.
So, uh, picture this. You're an everyday American navigating this economy right now under the current Trump administration.
Right.
And things probably feel, incredibly contradictory. You look at your wallet, you're paying a massive premium just to fill up your gas tank.
Yeah, the pump is brutal right now.
It really is. But then you're watching the financial news and suddenly everyone is screaming about global interest rate hikes. And you're just wondering, wait, what is going on?
It's a really confusing puzzle for, well, pretty much anyone trying to manage their money today.
Exactly. And that is our mission for this deep dive. Based on some really fascinating macroeconomic analysis we've been looking at from May 3rd, 2026, we're going to untangle this whole thing.
Because the media narrative is definitely missing the mark here.
Yeah, the headline you see everywhere is, central banks are raising rates. But looking closely at the data, the real story is so much more complicated. And, spoiler alert, it all comes down to oil.
It really does. I mean, the biggest misconception right now is that central banks are excited to hike rates. Like, they're not. We aren't in a phase where the global economy is booming and they just need to cool off the party.
Right.
We are actually in what the data calls an unable to cut phase.
An unable to cut phase. Okay,
Yeah.
break that down for us. Because if you just look at the raw economic numbers here at home, growth is clearly slowing down.
Yeah, absolutely.
Consumers are exhausted. So, in theory, central banks want to lower rates right now to give everyone a break.
Exactly. In a normal world, they'd be hitting the cut button. They want to make borrowing cheaper to stimulate the economy. But, and this is the huge but, they literally can't.
Because of the oil shock.
Yes. The ongoing Iran war has created this massive global supply shock. I mean, looking at the recent data, in late April, Brent crude hit a 4-year high of over $125 a barrel.
Wow.
And the markets are whispering that if the Strait of Hormuz gets blocked, it could easily hit 150.
Which is just terrifying because oil isn't just gas for your car, right? It's the plastic in your phone. It's the shipping cost for your groceries. It basically acts as a universal tax on the entire economy.
Precisely. And that tax bleeds directly into the inflation numbers. Like in the U.S., the March PCE, the Personal Consumption Expenditures Index, it crept back up to 3.5%.
And that's the specific inflation gauge the Federal Reserve obsesses over.
Yeah, it tracks what everyday people are actually buying. So if that number goes up, the Fed panics. They completely abandon their plan to cut rates.
And it's not just the U.S. Like, looking at the global reaction, the European Central Bank, the ECB, they held their rates steady on April 29th.
Right, but they heavily hinted at a June hike.
Yeah. You even had Germany's Bundesbank president publicly warning about actual rate hikes. And the Bank of England held rates on April 30th, but basically spent the whole time warning about inflation from the Iran war.
They are all essentially paralyzed.
It makes me think of an everyday analogy. It's like driving a car and the check engine light is flashing on your dashboard.
Okay, I like this.
So the flashing light is the slowing economy. You really want to pull over, take a rest, which is cutting interest rates. But you can't hit the brakes because there is a massive runaway truck of oil prices riding literally right on your bumper.
That is exactly what's happening. If you brake, the truck crushes you. So you're stuck speeding down the highway with a broken engine.
But wait, I got to push back on this a little bit. If everyone knows it's just oil causing it's a war overseas, the central banks can't control that. Why are they acting so tough? Why not just ignore the oil prices and help the consumer?
It's a great question. And it comes down to a concept called a hawkish hold.
A hawkish hold.
Yeah. Central banks are terrified of human psychology. If oil stays at $125 for months, people start to expect higher inflation.
So it gets into people's heads.
Exactly. Workers demand huge raises, businesses preemptively hike their prices, and suddenly inflation isn't about oil anymore. It's a permanent fixture in the economy. So they hold rates steady, but they talk incredibly tough. They sound hawkish to keep everyone scared and subdued.
They have to keep the financial brakes engaged even as the economy sputters. That's rough.
It is.
And honestly, it gives off a really terrifying sense of déjà vu because this feeling of slowing growth plus sky-high oil, we've seen this before.
We absolutely have.
According to the research, this sounds eerily similar to the infamous summer of 2008.
Yeah, the ghost of 2008 is definitely haunting Wall Street right now. If you look at the historical data, in July 2008, oil skyrocketed to $147 a barrel.
Which was wild back then.
It was unprecedented. And despite clear signs that the global economy was slowing down, the ECB actually raised interest rates by 25 basis points to 4.25%.
Just to fight the energy inflation.
Exactly. And today, investors are terrified that central banks are going to make that exact same mistake again, chasing energy inflation and accidentally crushing the whole economy.
But, we should probably clarify something for the listener, because comparing today to 2008 needs a bit of a reality check.
Oh, for sure. The underlying issues are totally different.
Right. Like in 2008, the global financial system was already rotting from the inside out, right? We had that massive housing and credit collapse. The oil price was just kind of accelerating it.
Yeah, the subprime mortgage crisis was the real disease in 2008. Plus, back then, the U.S. Fed was actually aggressively cutting rates, not hiking them. So it wasn't a universal strategy.
Okay, so the foundation was different. But based on the analysis we have, there is one core similarity that is still super dangerous today.
The policy trap.
The policy trap. This temptation to cure a bad supply shock, like a lack of oil, with a demand suppression policy, which means high interest rates.
That's the exact danger. Because central banks can't drill for oil. They can't make more supply. They can only crush demand.
Which means crushing us. Let me simplify this for the beginner investor listening right now. Imagine there's a huge shortage of apples in the world.
Okay.
So because of the shortage, apples get insanely expensive. That's our oil shock. Now, the central bank sees the expensive apples and says, we need to fix this.
Right.
But instead of growing more apples, their solution is to literally take away my paycheck so I can't afford to buy apples anymore.
That is spot on.
Like, sure, the price of apples might eventually stabilize because nobody's buying them, but now I'm broke.
Exactly. And that is the exact risk we're facing. They take away your purchasing power, and if they push that too far, this combination risks triggering a deep, really painful recession.
Man, so you've got everyday people going broke, but the prices of basic things are still super high. There's a specific, really miserable term for that, isn't there?
There is. It's called stagflation.
Stagflation.
Right. Stagnation in economic growth combined with high inflation. It is the ultimate trap for policymakers because their tools just don't work.
Because if you cut rates to fix the stagnation,
You explode the inflation. But if you hike rates to fight the inflation, you completely deepen the stagnation.
it's a lose-lose. And looking at the data, we actually have a perfect real-time example of a country caught in this trap right now, South Korea.
Oh, South Korea is the ultimate canary in the coal mine for this.
Mm.
On April 10th, the Bank of Korea, the BOK, held its rate at 2.50%.
Okay.
But at the exact same time, they officially lowered their 2026 economic growth outlook and raised their inflation outlook.
Wow. So they basically admitted we have stagflation.
Pretty much.
Yeah.
And it makes sense because South Korea relies so heavily on imported Middle Eastern energy for all their manufacturing.
Right. They make cars, electronics, all of that.
Yeah. So when oil prices spike, it acts like a wrecking ball. It smashes their corporate profit margins, it raises all their import costs, and it completely squeezes the everyday consumer's real income all at once.
That sounds absolutely brutal. And this isn't just a South Korean problem, is it? Behind closed doors, this is causing massive internal panic everywhere.
It's tearing central banks apart. According to recent analysis from April 30th, the U.S. Fed is currently seeing its highest level of internal disagreement since 1992.
Since 1992. Wait, really?
Really, half the officials want to hold firm. The other half are terrified of a recession. And the Bank of Japan, the BOJ, is seeing its biggest policy fracture since 2016.
Because the Bank of Japan is in an impossible spot.
Totally impossible. If they raise rates to fight the oil inflation, they crush their domestic real estate market. But if they keep rates low, their currency, the yen, completely crashes, and importing oil gets even more expensive.
So, okay, if things are this precarious, if central banks are divided, the economy is slowing, and we're staring at stagflation, I have to ask the million-dollar question.
Go for it.
Why isn't the stock market panicking right now? Like, you look at your portfolio, and things still seem relatively okay. Why hasn't it crashed?
Because right now, the market is basically blinded by the light.
Blinded by the light. What light?
The massive glowing hype of artificial intelligence.
Oh, wow, okay.
Yeah. The strong earnings momentum from these massive tech companies, the AI boom, is essentially acting as a giant distraction. Investors just haven't fully priced in the reality of a recession or a true oil shock yet.
So the AI profits are sort of masking the pain underneath the surface.
Exactly. But here's the thing. The real danger for the market isn't necessarily a sudden dramatic rate hike that crashes everything overnight.
Then what is it?
It's the agonizing pain of rates just staying higher for longer.
The slow bleed.
Yes, the slow bleed. Because think about companies with high debt. They borrowed money a few years ago when rates were basically zero. But eventually they have to refinance that debt.
And now they have to refinance at like 7 or 8%.
Exactly. And that massive new interest payment just slowly bleeds out their cash flow over time until they break.
Okay, so let's pivot here. We've talked a lot about macroeconomic theory. Let's bring this down to practical kitchen table reality for the listener.
Sure.
Rate cuts are basically a mirage right now. So what does this actually mean for the everyday investor listening to us?
Well, based on the May 3rd data, the most important thing you can do is change your mindset. You have to stop betting on rate cuts to save you.
Right.
Instead, you need to start trading the disappearance of cuts.
Trading the disappearance of cuts. Okay, so who loses in that scenario?
The biggest losers are any assets that rely on cheap money. So high valuation growth stocks, companies that promise huge profits 10 years from now, but make zero money today.
Because when money is expensive, you need cash today, not promises.
Exactly. It also hurts companies that rely heavily on domestic consumption. Because, as we said, everyday consumers are getting crushed by gas and groceries, and of course, companies that constantly need to borrow money to survive.
Okay, so if those are the losers, who actually wins? Looking back at the 2008 playbook, what survives a stagflation shock?
The assets that survive and actually thrive are things like commodities, energy stocks, defense stocks, especially given all the geopolitical tension causing the oil shock.
That makes total sense.
And if you're looking at regular equities, you want strong value stocks, companies that generate massive amounts of cash right now. Even stock exchanges and derivative infrastructures do really well.
Oh, stock exchanges? Why them?
Because they thrive on market volatility.
Yeah.
When everyone is panicking and trading frantically, the house always wins.
Oh, right. That's fascinating. But there's also a big global nuance to this too, isn't there? Like you can't just treat the whole world as one single market right now.
No, you really can't. You have to watch the divergence. There's no one-size-fits-all policy anymore.
Right, because earlier we said the ECB and the Bank of England are actually leaning toward real rate hikes.
Yeah. Exactly. Well, the U.S. Fed is just ditching their planned cuts. The Bank of Korea is stuck in that stagflation hold, and the Bank of Japan is just desperately trying to stop their currency from collapsing.
It's like every country is fighting a completely different war.
They are. So as an investor, you have to be really selective about where your money is geographically.
Man. Okay, let's try to summarize all this. We've covered a ton of ground today.
We really have.
To put it simply, the biggest threat to your money right now isn't just the high gas prices you see when you fill up your car. The real structural threat is that global central banks are completely backed into a corner.
Trapped.
Yeah, trapped. They are totally unable to rescue a slowing economy because of those high gas prices.
And that's the new reality we all have to navigate.
Absolutely. So as we wrap up, what's a final thought you want to leave our listeners with today? Something to kind of, mull over on their own?
Well, think about what we discussed regarding the stock market.
Right.
Right now, the market is basically balancing on a single massive leg, the huge boom in artificial intelligence.
Right, the glowing light distracting everyone.
Exactly. But if that AI momentum even slightly cools down, and interest rates are still locked at these punishingly high levels because of oil, what exactly is going to catch the market when it falls?
Oof. That is a heavy question to ponder. Because once that AI leg gives out, there's not much of a safety net left.
There really isn't.
Well, we will keep our eyes on the data and keep translating all of this for you as it unfolds. Don't forget to subscribe and hit that like button.